Inflation across the world has really rapidly risen, and it's a lot higher than what we've seen in the past. In fact, in a lot of major economies, we are seeing inflation up at 40 to 50-year highs, and in Australia, inflation is around a 15-year high. What's causing this is a lot of different factors, including some supply chain disruption from COVID, making it more expensive to get things from different parts of the world. We're also seeing in Australia that the very low unemployment rate is starting to lift people's wages, which is then being passed on to higher prices. And then there's also some factors including really strong fiscal stimulus, so lots of government spending, making people more confident to spend money. And when people spend more money, particularly on the same things at the same time, then those things become more scarce and prices rise. For example, when everyone's doing renos, it's a lot harder to get a tradie, and that makes the cost of finding that tradie a lot more expensive. When prices are rising too fast, it's a central bank's job to keep them in a good range. It means that prices are rising a little bit, which is good, but not too fast, which takes away people's ability to plan ahead and for businesses to plan ahead as well. So at the moment, when inflation is running really high, the Reserve Bank will reduce inflation by increasing their cash rate. The cash rate is the kind of official interest rate in Australia, and it cascades through to all the other interest rates we see, including personal loans, mortgages, and also business debt. What this does is it makes businesses and households think twice about spending more money or borrowing more money, because every dollar they borrow, it's a little bit more expensive. And on the other hand, it also helps people to save more money because they're actually getting a bit higher of a reward from that savings. So when the Reserve Bank raises the interest rates, it's helping people save and making people think twice about spending. And when people think twice about spending, they're less likely to spend more and spend it on the same things, which can make things more expensive. So that's how we reduce inflation. Some people think that it means a lot of people won't be able to pay their home loans on time. However, our research shows that a lot of people are paying a lot more than they have to on their mortgages. We also think that the unemployment rate is going to stay really low over the next couple of years, which will help people get pay rises. In 2023, we think that pay rises will be higher than they've been in the last 10 years, and we think that will continue and allow people to absorb some of those extra interest payments from home loans or personal loans through their higher paychecks. Generally too, a higher interest rate does mean the economy is going well. When the Reserve Bank is able to raise interest rates, it means it can make business a little bit more expensive to run without hurting the economy, and we really expect this to be the case. Businesses have been booming in a lot of sectors in Australia, and that's part of the reason that inflation has become a lot higher and will persistently be a lot higher in the next couple of years than it has in the last 5 to 8 years. There's of course risk, there's always going to be winners and losers in these scenarios, but we think that on balance, most people are going to be able to muddle through these cash rate increases okay. We're still going to see okay spending, we're still going to see businesses do well and keep workers and keep those pay rises going too. And we do see the economy really in a lot of ways going better than it did before COVID over the next couple of years.